Bitcoin has completed 4 identifiable full market cycles since 2011. Each featured a period of rapid price appreciation, a speculative peak, a severe drawdown, and a subsequent recovery that set a new structural floor above the prior cycle's baseline. The amplitude of each cycle has compressed progressively, from 10,000% gains in Cycle 1 to 640% in Cycle 3, consistent with increasing market depth, institutional participation, and information efficiency. For institutional investors, the question is not whether crypto cycles exist. The empirical record is clear. The question is whether these cycles contain actionable signal for portfolio construction decisions, or whether they are identifiable only in retrospect. This video examines the structural drivers of crypto cycles, the on-chain metrics institutional analysts use to assess cycle phase, and the practical portfolio implications of cycle-aware positioning. We approach this as signal analysis, not market timing, a distinction that matters enormously for fiduciary mandates. Crypto market cycles consistently exhibit 4 structural phases, each with distinctive on-chain and market characteristics. The accumulation phase follows a major bear market. Price is depressed, range-bound, and unremarkable. Retail participants have largely exited. On-chain data shows a high percentage of circulating supply held by wallets with long holding periods and significant unrealized losses. The patient, often institutional, money accumulating at cycle lows. The expansion phase begins when price breaks decisively above prior resistance on increasing volume. This phase is characterized by rising institutional inflows, increasing active addresses, and the first wave of mainstream media coverage. Retail FOMO is still early. The distribution phase is the most dangerous for undisciplined investors. Price sets new records. Derivatives markets show elevated funding rates, the cost of holding leveraged long positions, indicating excess optimism. Long-term holders are systematically distributing into strength. Social media sentiment and search interest for Bitcoin reach extreme levels. The contraction phase that follows is frequently more severe and longer than investors anticipate. The unwinding of excess leverage, regulatory responses to speculative excesses, and the reversal of macro conditions that supported the prior expansion all compress price over 12 to 18 months or longer. The historical record reveals a consistent but evolving pattern. Each of Bitcoin's 4 completed cycles featured a peak drawdown between 77 and 93% from the cycle high, a range that is both remarkably consistent and remarkably severe by traditional asset standards. The 2011 cycle saw a 93% drawdown to $2. The 2013 cycle reached $1,163 before declining 86% to $160. The 2017 ICO-driven bull market peaked at $19,800 and subsequently lost 84% over 12 months. The 2021 cycle peak of $69,000 gave way to a 77% decline to approximately $15,600 in November 2022, the shallowest drawdown of any completed cycle. 2 observations are critical for institutional analysis. First, drawdown magnitude has been decreasing with each cycle, consistent with deeper liquidity, more sophisticated market participants, and more developed derivatives markets that allow hedging rather than pure exit. Second, the 2024 cycle introduces spot ETF demand as a structural constant, potentially creating a demand floor that did not exist in prior cycles. Whether this materially compresses future drawdowns remains an open empirical question. Professional on-chain analysis uses 5 primary metrics to assess cycle phase with greater precision than price action alone. The MVRV ratio, market value to realized value, compares the current market price to the average cost basis of all circulating Bitcoin. When MVRV exceeds 3, the average holder is sitting on significant unrealized gains, a condition historically associated with distribution phases. When MVRV falls below 1, the average holder is underwater, historically associated with accumulation zone conditions. SOPR, or spent output profit ratio, measures whether coins being spent on-chain are doing so at a profit or loss. Sustained SOPR above 1 indicates profitable spending, typical of expansion and distribution phases. SOPR below 1 indicates capitulation selling at a loss, associated with cycle bottoms. Long-term holder percentage, the share of supply held in wallets that have not moved coins in 155 days or more, rises during accumulation and falls during distribution as long-term holders transfer to exchanges. Exchange net flows measure whether Bitcoin is moving onto exchanges, potentially for sale, or into cold storage. Sustained exchange outflows during a rally indicate long-term holders absorbing supply rather than selling into strength. Funding rates on perpetual futures market spike during distribution as leveraged longs pay elevated rates to maintain positions, an early warning of speculative excess. 3 significant risks attend cycle-based positioning strategies, risks that are particularly consequential for institutional and regulated mandates. First, macro override. The 2022 crypto bear market began and accelerated in direct response to Federal Reserve policy tightening, not because on-chain cycle metrics indicated a distribution phase had peaked. Multiple metrics that institutional analysts use as cycle indicators were in mid-cycle ranges when macro conditions triggered a sharp reversal. Any cycle framework that does not incorporate the macro interest rate environment will produce incorrect signals during policy regime transitions. Second, black swan distortion. The FTX collapse in November 2022 produced a cascading set of forced liquidations, exchange outflows driven by panic rather than fundamental cycle dynamics, and MVRV signals that temporarily resembled cycle bottom conditions while the market had significant further downside. External idiosyncratic shocks corrupt cycle metrics. Third, fiduciary liability. For registered investment advisors and pension fund managers, any investment activity described as market timing creates potential liability exposure when the timing is incorrect. On-chain cycle analysis is most appropriately used to inform strategic allocation range decisions, adding to positions within the accumulation zone and reducing within distribution, rather than aggressive tactical shifts. One of the most structurally important features of Bitcoin's cycle history is the progressive elevation of cycle trough prices. The 2011 cycle bottomed at approximately $2. The 2013 cycle bottomed at $160. The 2018 cycle at approximately $3,100. The 2022 cycle at $15,600. Each successive trough was orders of magnitude higher than the previous, establishing a higher structural floor for the asset even through severe percentage drawdowns. This trough elevation pattern is consistent with genuine adoption growth, more long-term holders, more institutional participants, more developed derivatives markets for hedging, and deeper liquidity all work to support progressively higher price floors during bear markets. For institutional investors with long-time horizons, this pattern supports a strategic accumulation approach by during acknowledged bear market phases, when MVRV is below 1 and long-term holder percentage is rising, and maintain position through subsequent cycles rather than attempting to exit at peaks. The compound return from this approach across the 2013 to 2024 period has been extraordinary, even accounting for the severity of intermediate drawdowns. Whether this pattern extrapolates to future cycles depends fundamentally on continued adoption growth and regulatory clarity, both of which are progressing, not reversing. 5 principles for applying cycle analysis within institutional frameworks without crossing into prohibited market timing activity. First, use cycle phase to inform allocation range decisions, not point estimates. During demonstrated accumulation phases, operate at the top of your strategic allocation range. During distribution phases, operate at the lower end. This is allocation range management, not market timing. Second, use composite on-chain signals rather than single metrics. MVRV, SOPR, and long-term holder percentage used together provide more robust signals than any individual indicator. Always overlay macro conditions before acting. Third, maintain a minimum policy allocation regardless of cycle signals. The downside of being out of the market during a sudden expansion phase, as Bitcoin demonstrated in early 2023 with a 50% rally during what many characterized as a continued bear market, can exceed any cycle timing benefit. Fourth, document your rationale. Investment committees benefit from written records of how on-chain data informed any allocation decisions. Fifth, calibrate confidence modestly. Each cycle introduces new variables. The 2024 cycle with ETF demand is categorically different from 2020 or 2016. Treat historical patterns as starting points for analysis, not deterministic guides. Understanding crypto market cycles separates investors who capture the long-term adoption premium from those who buy peaks and sell troughs. Crypto mechanics provides the analytical frameworks that allow professional investors to read markets with the clarity and discipline that institutional mandates demand. Subscribe now.